Now, the first one is to do with this emergence of what he calls Bitcoin treasury companies, which is in effect what his company has started out on this train journey of issuing debt in order to buy Bitcoin as that long-term store of value and to act as an increasingly hedge against inflation. And for me, it's not just inflation, against entropy and chaos out there in the world. And as a result, he cited some interesting recent announcements at the Bitcoin Las Vegas conference last week, where Trump media have actually announced that they were going to issue debt, $2.5 billion worth of debt, in order to buy Bitcoin and store it in their corporate treasury reserve. And then similarly, 21 Capital, where they've actually partnered with the likes of Tether, SoftBank and Cantor Fitzgerald, which is headed by Jack Mallers. They're doing something similar. And also, what's striking about 21 Capital and Jack Mallers, he's also the CEO of Strike. In addition to the Bitcoin treasury company, there is also a notion of a Bitcoin development company, which is pretty much all about issuing those financial products that have Bitcoin bolted on, such that whenever the institutional lenders of the traditional debt or bonds, well, by bolting on Bitcoin, it will make the rate of return much more attractive to those lender issuers. And this is where Strike have actually rolled out an interesting product, a lending product, where they can issue fiat loans based on Bitcoin as collateral. Well, there isn't any need to part with your Bitcoin holdings. So in effect, you're going to be still holding on to your Bitcoins, even though it's under the custody of these financial products, platforms. Throughout the duration of the fiat loan, you still be able to have access to your Bitcoin collateralized holdings, and at the same time enjoy the fiat loan that you've taken out, which kind of forces like a vicious cycle whereby on the one hand you're getting fiat loans and you can do whatever you want with it. He's actually cited to actually invest part of that loan into purchasing more Bitcoins. But that's just one example of a Bitcoin collateralized loan in operation, because there is that emerging need, at least for my side, I'm seeing that frustration, ongoing frustration as to why I need to part with my Bitcoins in order to sell them off, in order to get the gains, and then I have to worry about a taxable event. I incur tax payments to my tax authorities, which is not the case with these Bitcoin collateralized loans. But like I said in one of my earlier videos, you need to do that research. You need to ensure that the actual Bitcoin collateralized loan lender, if you like, or platform lender like Strike, is a registered security in your jurisdiction, because they need to be able to have authoritative licenses in order to operate these type of loans. But nevertheless, this is something that we're seeing as a result of this enlargement of the Bitcoin ecosystem into the mainstream. It's not just acting as a treasury reserve, but also increasingly now as a development company through the issuance of these financial products, where Bitcoin is bolted on as a component feature of those. So that is an interesting take from Michael. I like to end this point about this is all good and well, but you need to do that research. And it also raises the important point about the need to take self-custody more seriously, more than ever before, because these treasury companies and also these development companies focusing on Bitcoin ecosystem, there's still counterparty risk. And I recall vividly Michael himself have made that painfully clear. He actually raised his hand and said, well, his company's strategy, used to be called MicroStrategy, is still nonetheless that counterparty risk, which investors ought to do their own due diligence and satisfy themselves whether it's a tolerable risk that they're able to handle and to stomach. So this is the reason why investors ought to do that kind of balancing act as to how much of their Bitcoin holdings they are willing to place under the custodianship of these counterparties versus holding the rest of your holdings, Bitcoin holdings or digital asset holdings, through your Trezor device or your Nano X Ledger device under self-custody regime. But of course that comes with additional responsibilities. You need to be wary about not falling foul to possible scams, because the scams are increasingly, unfortunately, as with every new technology, there is that appetite for scammers to exploit the vulnerabilities of that and start poaching Bitcoin hodlers to release their private keys, their seed phrases, passphrases in their websites, or through SMS or through tuberous links in emails, which is all the more reason why you ought to completely divorce yourself from all of that and just keep your private keys safe in a confidential means. Again, I have a separate podcast series that will give the tips and tricks on crypto measures you ought to consider taking in place to avoid being approached by these scammers. So there's a lot of things happening in the Bitcoin ecosystem, and Michael is right in that the treasury companies, the trend has been set. There's going to be more and more public companies following suit. There's currently over 150 publicly registered companies around the world who've adopted what Michael Saylor's strategy team has set in terms of the Bitcoin standard, i.e. issuing debt in order to purchase more Bitcoins and use that as a collateral, a store of value collateral in the corporate treasury reserves moving forward. And then, like I said, there's going to be development companies who are going to dedicate themselves to producing financial products, bolting on the Bitcoin component as a feature for those investors out there. So this trend is set to continue. And as a final point, you need to do your legwork and take self-custody more seriously, more than ever before, precisely for the reasons I just mentioned, that these companies are still remain a counterparty risk, and you need to do that kind of cost benefit analysis as to how much of that you're able to tolerate versus storing the rest of your Bitcoin or digital holdings under a self-custody regime, which would be my advice ultimately, which is how I'm doing it with my digital asset holdings. This brings on to the next point about the underlying thesis of Bitcoin as a result of these actors, institutional actors coming in and investing into the Bitcoin asset class. I've talked about treasury companies, development companies in Bitcoin. Would that change the underlying thesis of Bitcoin, which was all about being a bottom-up asset class for the people, by the people? But nevertheless, we are seeing other actors out there. And Michael's answer to that question that's been raised in the interview, I think it makes total sense. It is always good to have healthy competition, not just with Bitcoin, but indeed with every type of asset classes out there. This is no different. It's just healthy competition. Whether it's the pursuit of strategic Bitcoin reserves by more sovereign nations. You recall that President Trump have enacted an executive order outlining the US desire to have a strategic Bitcoin reserve at the federal level. But there's going to be other nation states, and Michael cited quite a few of those, that are copycat that same position of the US. And this train journey is set to continue for the rest of the countries out there in order to not fall behind with what the US are doing. And as I said before, there's even healthy competition as a result of the spurt of new Bitcoin treasury and development companies out there, and increasingly more institutions, more public, even private companies, driving more capital demand, more capital inflows into the Bitcoin asset class. And also for the rest of us, retail long-term hodlers of the Bitcoin. But what we have seen as a result of the volatility of the asset class, which is, as I said, no different with any other asset class that you're familiar with, whether it's high-graded equity stocks or commodities, is we need more retail long-term hodlers driving their capital asset wealth from the traditional finance arena into Bitcoin and to hold into the long term. But at the same time, that comes with a responsibility to divorce yourself away from the noise, the scaremongering, the shenanigans from Wall Street, TradeFi and other capital markets around the world. We need to divorce ourselves completely from any noise, because that's the intention of the elite, of the collective. They precisely use that as a scaremongering tactic in order to bring down the price of Bitcoin by releasing and selling off their Bitcoin assets back into the marketplace, which will drive down the price of Bitcoin down. But they use it as a momentary golden opportunity to buy at the dip, in which case what we have seen, there's a sudden spike back at the top, which unfortunately for those that have fallen into that trap find themselves in a much worse position, that if they want to inadvertently come back and drive more investment into Bitcoin, they will have to do it, albeit at a more expensive price, which is all the more reason why I've been advocating in many of my videos in my channel, which is all the more reason why you ought to subscribe to it to learn more. We need to become a more resilient retail investor more than ever before against the shenanigans, against the elite, against these large institutional graded companies, even now the sovereign nations, the Bitcoin treasury, the Bitcoin development companies. They're coming out at all angles, left, right and center. And we, as a retail investors, we should not be left out of that train journey. The only thing is we need to invest. And once you invest in the asset, please just forget about the noise out there and just stick to your long-term conviction holding of the asset. Because when you decide to, let's say, sell some of that when you reach, let's say, the age of retirement, or when you want to transfer your wealth to your next of kin, well, they'll be the ones left standing the best in terms of reaping the majority of the rewards as a result of your courageous efforts to hodling to the Bitcoin asset class and your investment holdings into the long term. I can't stress that enough. So the underlying thesis still remains unchanged. We just need to bring more resilient retail investors and move away from the day traders who like to speculate the asset, time the market, which is something I've always been advocating against not doing, right? Because no one can beat it. In fact, 99.9% of these traders will end up losing money. So that is the point about underlying thesis. Healthy competition amongst the Bitcoin actors in the ecosystem is a healthy thing and is no different to how you would do it with your other asset investments. This leads to my last point. In fact, it's the most important point from this interview with Michael, and this is to do with his definition of the 4 new asset classes underpinning the crypto industry. The first one is digital commodity, which at the moment Bitcoin is the king of all digital commodities. He even claimed that there may be some others. I doubt there'll be any others anytime soon, at least in my generation, because there's $2 trillion already been invested in the Bitcoin. Who would want to back another horse? They would have to start from scratch. And Bitcoin has already been set in mainstream. We've got various actors. We've got the sovereigns, we've got the institutional graded companies investing in the asset classes, we've got the fintech players who are creating these layered model apps on top of Bitcoin base layer. So there's just too much that's already been invested into the asset class to suddenly bring in a brand new kid in the block to compete with Bitcoin. I don't see that changing. So for me, digital commodity is ultimately Bitcoin. So that's the first one that he's explained. This brings on to the next category, which is digital currency, which is like stablecoins that are backed by fiat currency. Let's take the example of the US dollar backed stablecoin, which is fundamentally Tether, and also there is Circle. You've got USDT, which is Tether, and you've got Circle, which is USDC. They're both US backed stablecoins, and those are the 2 major leading ones, digital currency out there. So that is used more as a medium of exchange for those cross-borderless payments over the digital rails system, rather than having to use your credit card or bank-to-bank transfer in SWIFT, because as we all know, that is very expensive. It's 2.5%, 3% transaction fee every time you do it, and it takes often several days to settle those transactions, which is in stark contrast with stablecoins. If you were to use stablecoins for that, like Tether, it will be a matter of a few seconds, if not a fraction of a second, at a fraction of a cost. That is the difference. And also other advantages of treating stablecoins as digital currency, as a medium of exchange type asset, is to enable those that are maybe debanked or unbanked. Let's take the example of Africa. There's several countries who are unfortunately not in a privileged position as we are to have a bank account. So stablecoins would enable even those types of population world to participate into using Tether as a stablecoin for those day-to-day expenses. So digital currencies play an important role in the crypto industry. The next one is digital security. So digital security are like financial assets that can be tokenized onto the blockchain. So things like tokenized bonds, equities that can be tokenized on the blockchain and can be traded and participated by investors. If you were to tokenize all of that as a digital security token on the blockchain, well, it's 24/7, it's Monday to Sunday, and it's worldwide accessible, which is not the case in TradeFi. And then this leads to the last classification type, which is digital tokens. So for me, these are like real world assets, tokenizations fundamentally. So tokenizing other utility tokens that have that economic value, which can be speculated and traded upon on the blockchain. So things like tokenizing football teams, basketball teams, or even your fan clubs, tokenizing real estate properties, particularly premium real estate. Those are digital utility tokens that can be tokenized and traded on the blockchain. And if you bear in mind that there are more or less 400 million companies established out there in the world, you can see that if they were to convert part of their business into digitizing their use cases in their company in order to attract the capital into the blockchains of that digital utility token. Well, this is fantastic, because the idea behind digital utility tokens is to precisely drive in more capital, to raise capital like crowdfund or what have you, or business angels. Well, it's the same sort of concept. You raise capital in order to issue these digital utility tokens on the blockchain, sell it to the market participants, the investors, and make money, speculate with, albeit under a more shorter term horizon. But not to be confused with digital security, which has much more liability and much more regulatory constraint, if you like, in terms of how they operate. It's not the same thing as how banks or financial institutions digitize their tokens versus the rest of the digital utility tokens like real estates, fan clubs. It's completely different with its own liabilities, which is all the reason why Mike has explained or differentiated between digital security and digital utility tokens, which I have to admit I found it confusing, but when he explained that difference, I immediately resonated and agree with that distinction, which is why we have these four asset classes driving capital wealth into the crypto industry at large, where we have digital commodities, Bitcoin, followed by digital currency, which are stablecoins, in order to accommodate media of exchange type transactions in our day-to-day, leading to digital security, so tokenizing US Treasury bonds, equity graded stocks that can be traded and accessible by the worldwide market on 25/7 from Monday to Sunday. And then lastly, digital utility tokens for the rest of the real world assets tokenization type assets that have that economic value that themselves can be tokenized and traded with on the blockchain. And I want to round off a word of note, particularly on these fintech players that are going to be ultimately responsible for implementing these four category asset classes, leaving digital commodity aside. And with that, again, I have been explaining this point in many of my videos, is the need to do your legwork as a consumer, as that prospective investor for digital currencies, for digital securities, for digital utility tokens. You need to do that legwork to reassure yourself that those fintech players, those security firms, are indeed licensed by your local financial regulator, because ultimately without that they are unable to commercially sell and position these digital tokens on the marketplace. The important point from Michael is digital protection for consumers needs to be enshrined within this digital assets framework, which is being worked on at the moment in various jurisdictions. And this is all the more reason why I keep explaining that you need to do that legwork. Please always check that these operators, these fintech players, or these exchange platforms for crypto are licensed financial operators of those platforms. So that is the last point that I'd like to leave you today. There's an awful lot happening, and these comments at the Bitcoin conference is an eye-opener. And what I took from that is it's not just about Bitcoin, even though for me Bitcoin is the king of all digital commodities, and I'm using it as a store of value in order to preserve and grow my wealth in the long run. But it's interesting to see there are different types of digital assets, digital currencies for day-to-day, because I don't want to use my Bitcoin to buy a book, for heaven's sake. You can use Tether for that. And likewise, if I want to invest in tokenized bonds, because I know that governments are going to find it very difficult to get hold of new money or new debt. Well, clearly there's a gap in the market fundamental US tokenized treasury bills on the blockchain. So that could be an interesting feature, and that is an example of digital security. Again, interesting investment potential there. And as well as digital equities and digital tokens for the rest of the real world assets tokenization. There's a lot of business to be had, and it's buoyant and it's growing. So that is the message I'd like to leave you today. If you enjoyed today's episode, incidentally, please don't forget the like button to share the video to colleagues and friends. And if you haven't done so, please subscribe to my channel, as I regularly publish some interesting videos such as these. Anything to do with Bitcoin, blockchain technology, and the future of finance. So till next time.